All right, let's dive into some serious financial drama.
Oh, yeah.
Today we're going to crack open Andrew Ross Sorkin's Too Big to Fail.
Okay.
It takes you behind the scenes of the 2008 financial crisis.
Oh, right.
We've got excerpts from the book, some pretty intense research, my own notes, and I have to say,
Yeah.
it's a wild ride.
Really?
We're talking Wall Street power players,
Oh, wow.
decisions that reshaped the global economy,
Uh-huh.
and moments that'll make you wonder, like,
Yeah.
how did this even happen?
What's really striking about this story is how quickly these seemingly small cracks
Right.
in the system turned into like a full-blown earthquake.
Yeah.
So we'll be exploring
Okay.
the personalities, the power struggles, and just like the domino effect
Right.
of decisions that led to a crisis that many are still feeling today.
You know, I was just floored by this one detail about the CEO of Merrill Lynch
Oh, yeah.
redecorating his office with a $35,000 commode
What?
right before everything hit the fan. Wow. It really makes you think about, like, the disconnect
Yeah.
between what was happening to Wall Street and the reality for everyone else.
It really highlights the bubble of excess and hubris that existed at the time.
Right.
It's a stark contrast to the millions of people
Yeah.
who were, losing their homes and their savings as the subprime mortgage market just imploded.
Okay, so let's rewind a bit.
Sure.
Can you break down this subprime mortgage crisis for us?
Right?
How did it start?
Okay.
And how did it spread so quickly?
Well, it all began with lenders giving out mortgages to people with
Yeah.
poor credit and low income,
Right.
often with adjustable interest rates.
Okay.
And these rates would start low,
Huh.
but then balloon to much higher payments after a few years. It was
Yeah.
a ticking time bomb.
Wow.
And then these risky mortgages were bundled together
Okay.
and sold as securities to investors
Yeah.
who, in many cases, didn't really fully grasp the risks they were taking on.
So it was like, building a house of cards, but with people's homes instead of playing cards.
Exactly. And the problem was everyone was in on this game. Banks, hedge funds, even international investors.
Right.
The financial system was so interwoven that when the subprime market started to collapse, the losses spread like wildfire.
Yeah.
Nobody knew who was holding what or how much exposure they had to these toxic assets.
It's almost unbelievable that even Ben Bernanke,
Right.
the Federal Reserve chairman,
Yeah.
initially thought the subprime crisis wouldn't significantly impact the broader economy.
Well, that's right. In early 2007, Bernanke testified before Congress
Yeah.
that the impact would likely be contained.
Uh-huh.
But he vastly underestimated the problem.
Wow.
By August of that year, the $2 trillion subprime market had imploded.
Oh, wow.
And Bear Stearns hedge funds that had bet big on subprime
Okay.
were losing billions.
Okay, so let's talk about Dick Fuld,
Okay.
the CEO of Lehman Brothers.
All right.
The book kind of paints him as a force of nature, intense, demanding,
Yeah.
almost obsessed with Lehman's success.
Fuld was very much
Yeah.
a product of Wall Street's win-at-all-costs culture.
Okay.
He climbed the ranks at Lehman, starting as a trader,
Yeah.
and he developed a deep,
Right.
almost emotional attachment to the firm.
Yeah.
He saw its success as his own.
There's a story in the book about Fuld
Uh,
being rejected from the ROTC program
what?
because of a fight he got into.
Oh, wow.
He apparently used that rejection as fuel to succeed in business.
That anecdote
Yeah.
speaks volumes about Fuld's personality. It shows his competitive nature
Uh-huh.
and his tendency to see the world as like black and white winners and losers.
Right.
This mentality,
Yeah.
coupled with his unwavering loyalty to Lehman,
Yeah.
really heavily influenced his decisions during the crisis.
So even early on, we see signs of Fuld's resistance to outside influence.
Yeah.
The book mentions he was opposed to the Lehman-Shearson merger back in the day.
Exactly.
Yeah.
That opposition foreshadows his later struggle
Okay.
to accept the possibility of selling Lehman or merging with another firm.
Right.
He saw it as like a personal defeat,
Uh-huh.
a betrayal of everything he'd worked for.
Yeah, it's fascinating how
Right.
individuals' personalities
Yeah.
can have such a massive impact on global events.
Absolutely.
But even with Fuld's confidence,
Okay.
there were clearly warning signs that Lehman was in trouble, right?
Absolutely.
Yeah.
Analysts, including Michael Delband,
Okay.
Lehman's head of fixed income,
Right.
were raising flags about the firm's vulnerability,
Uh-huh.
especially its exposure to real estate.
Right.
However, Fuld and his inner circle largely ignored these warnings.
It seems like instead of acknowledging the problem, Lehman tried to
Yeah,
project an image of strength.
that's right. And
Yeah.
Aaron Callan, Lehman's CFO, gave a very successful earnings call in March of 2008,
Uh-huh.
calming market fears and temporarily boosting the firm's stock price.
Okay.
They also initiated capital raising efforts
Right.
to shore up their balance sheet.
The book does a great job of contrasting Callan's outward confidence
Right.
with the mounting internal concerns at Lehman.
Uh-huh.
It's like they were putting on a brave face for the public
Yeah.
while privately trying to plug holes in a sinking ship.
That contrast really
Yeah.
highlights the gap between perception and reality at the time.
Right.
Lehman was desperately trying to maintain investor confidence,
Yeah.
but behind the scenes, they were beginning to realize the severity of their situation.
And then there's David Einhorn,
Yeah.
the hedge fund manager,
Okay.
who publicly criticized Lehman's accounting practices
Right.
and started betting against the firm.
Oh, wow.
This really seemed to get under Fold's skin.
Einhorn's criticism was a pivotal moment.
Okay.
He openly questions Lehman's valuation of its real estate holdings,
Right.
accusing them of hiding losses.
Okay.
This created a wave of negative publicity
Yeah.
and further eroded investor confidence.
Right.
Adding fuel to the fire was
Yeah.
Fold's conviction that Goldman Sachs
Okay.
was behind this campaign against Lehman,
Yeah.
which further fueled his paranoia and distrust.
Which brings us to Hank Paulhan,
Yeah.
the Treasury Secretary,
Yeah.
who was a former Goldman Sachs CEO himself.
Talk about adding another layer of complexity to this whole story.
Oh, I know, right?
Paulson's Goldman Sachs background was both an advantage and a burden.
Right.
He understood Wall Street inside and out,
Yeah.
but he was also very aware of potential conflicts of interest
Uh-huh.
and how the public would perceive a bailout for his former colleagues.
And those conflicts of interest became
Yeah.
a major issue when the government had to step in
Yeah.
and rescue Bear Stearns.
Right.
What happened there?
When Bear Stearns, another major investment bank,
Yeah.
was on the verge of collapse,
Uh-huh.
the Federal Reserve, with Paulson's backing,
Okay.
orchestrated a hurried sale to J.P. Morgan Chase.
That's where we get that famous quote from Jamie Dimon,
right.
the CEO of J.P. Morgan.
Yeah.
Buying a house is not the same as buying a house on fire.
Exactly.
Yeah.
Diamond was essentially saying that J.P. Morgan was doing the government a favor
Yeah.
by taking on Bear Stearns and preventing a wider meltdown.
Right.
However, this bailout set a dangerous precedent for future interventions.
The book really captures how much Paulson struggled
Uh-huh.
to defend the Bear Stearns bailout
Yeah.
to the public and Congress.
Yeah.
People were furious that taxpayer money was being used to rescue a Wall Street firm.
The political backlash was fierce.
Yeah.
Many people saw the bailout as rewarding reckless behavior
Right.
and creating a moral hazard.
Okay.
The idea that if companies believe will be bailed out, they'll take even greater risks in the future.
There's a great irony in the fact that Paulson refused himself
Yeah.
from Goldman-related matters only to need their help later in the crisis.
That irony really underscores the interconnected nature of Wall Street.
Right.
Even with the best intentions,
Yeah.
it was impossible for Paulson to completely separate himself from his former firm,
Right.
especially in a crisis of this magnitude.
Right. So the Bear Stearns bailout
Yeah.
was just the tip of the iceberg. As Lehman Brothers started to falter,
Right.
Paulson was determined to avoid another government intervention,
Okay.
believing a private sector solution was the only way to prevent
Yeah.
further erosion of confidence in the markets.
Yeah, he was in a tough spot,
Yeah.
under intense pressure from Congress and the public to avoid another bailout.
Yeah.
But he also knew the potential damage if Lehman Brothers were allowed to collapse.
Right.
It was a high-stakes balancing act.
So when it became clear that Lehman was in deep trouble,
Yeah.
did they try to find a buyer?
They did.
Okay.
There were several attempts to find someone willing to
Yeah.
take on Lehman Brothers, Korea Development Bank,
Uh-huh.
Bank of America,
Yeah.
and Barclays were all considered.
Sounds like a pretty desperate scramble to
Yeah.
save a sinking ship.
A very apt analogy.
Wow.
As Lehman's situation worsened,
Yeah.
the sense of urgency grew,
Right.
and the stakes got higher.
Right.
Remember, this wasn't just about Lehman Brothers.
Right.
The interconnectedness of the financial system
Yeah.
meant their failure could trigger a chain reaction
Oh, wow.
with unpredictable consequences.
The book describes some pretty tense meetings
Yeah,
between Dick Fold and potential buyers,
right.
especially Ken Lewis,
Yeah.
the CEO of Bank of America.
Mm-hmm.
It seemed like Fold might have
Yeah.
overplayed his hand a little bit,
Yeah.
believing Lehman was worth more than anyone was willing to pay.
Fold's miscalculation was
Yeah.
was a key factor in Lehman's downfall.
Right.
He clung to the belief that Lehman could be saved as an independent entity, even as the world around him was crumbling.
There was also Bob Diamond,
Right.
the CEO of Barclays,
Yeah.
who seemed genuinely interested in acquiring Lehman.
He did.
What was his motivation?
Diamond was an ambitious character.
Okay.
He had a vision of transforming Barclays into a global financial powerhouse.
Right.
And he saw the potential in Lehman's assets and talent.
Okay.
He was a risk taker.
Yeah.
But major obstacles stood in his way.
It sounds like regulatory hurdles were a big problem for Barclays.
Absolutely. Barclays was a British bank.
Right.
And acquiring Lehman would have required approval from British regulators, which was far from certain.
Right.
There were also serious concerns about Lehman's massive derivatives exposure and the potential for hidden losses.
Meanwhile, you had the New York Fed, led by Tim Gaithner, desperately trying to broker a deal and prevent Lehman from going under.
Gaithner was in a pressure cooker.
Yeah.
He was trying to find a private sector solution while also trying to avoid direct government intervention. On top of that, he was dealing with conflicting agendas and strong personalities, which made his job incredibly difficult.
The weekend leading up to Lehman's collapse?
Oh, yeah.
Sounds absolutely chaotic.
It was.
Paulson basically summoned all the major Wall Street CEOs to the New York Fed and told them to find a solution without government help.
Yeah.
Can you imagine being in that room?
That weekend was a pivotal moment in the crisis.
Yeah.
The fate of Lehman Brothers.
Right.
And maybe even the entire financial system.
Wow.
Hung in the balance.
Yeah.
Paulson's message to the CEOs was blunt.
What was it?
You created this mess, now you clean it up.
And they failed?
They did, despite intense negotiations and countless proposals. Nobody was willing to buy Lehman Brothers without substantial government backing. The banks were simply too terrified of taking on Lehman's unknown risks and liabilities.
So on September 15th, 2008, Lehman Brothers filed for bankruptcy.
Right.
The largest bankruptcy filing in U.S. history.
Lehman's bankruptcy sent shockwaves through the global financial system. It proved that even the biggest firms were not immune to the crisis and that the government wasn't always going to be there to catch them.
It's amazing to think that just days before, Paulson was saying that a Lehman bankruptcy was unthinkable.
The speed at which events unfolded is truly staggering. 1 minute they were searching for a buyer. The next they were filing for bankruptcy.
Wow.
It shows just how fragile the financial system was and how quickly a crisis like this could spiral out of control.
Okay, so Lehman goes down. And suddenly everyone's attention shifts to AIG. The insurance giant. What was their role in all of this?
AIG had been insuring mortgage-backed securities through something called credit default swaps. They were essentially guaranteeing investors against losses on those securities. When the subprime market crashed, AIG was on the hook for billions of dollars in claims.
So AIG was basically insuring the entire housing market bubble.
That's a good way to put it.
Wow.
And the problem was AIG had vastly overextended itself. They didn't have enough capital to cover potential losses.
Wow.
And they were facing a classic run on the bank.
It's incredible that AIG was on the verge of collapse.
I know.
At the same time, Lehman Brothers was imploding.
Those were dark days.
Yeah.
The financial system was melting down.
Right.
And nobody knew what would happen next.
Wow.
The government was facing a truly existential threat.
And in the end, they decided that AIG was too interconnected to fail. Their collapse would have been a disaster.
It would have been
for the entire global financial system.
Paulson and Geithner realized that AIG's failure would have been far worse than Lehman's.
Wow.
They were insuring trillions of dollars in assets held by banks and investors all over the world. Their collapse would have been a financial nuclear bomb.
So the government stepped in with a massive bailout for AIG, an $85 billion loan. And of course, that didn't come without controversy.
The AIG bailout was even more controversial than the Bear Stearns bailout. It was a much larger sum of money. And it involved an insurance company, which many people felt was further removed from the core of the financial system.
The book talks about the incredible tension between the banks as they tried to structure the AIG bailout and protect their own interests.
Absolutely.
It was like a pack of wolves fighting over scraps.
That's not far off.
Wow.
You had Goldman Sachs and JT Morgan
Okay.
Both maneuvering for position,
Right.
using their influence to try and shape the deal to their advantage.
It's a stark reminder that even in a crisis, self-interest often wins out.
Often does.
And ultimately, the government took control of AIG.
They did.
A pretty stunning turn of events.
The AIG bailout marked a major shift in the government's response to the crisis.
Right.
It showed they were willing to go to extraordinary lengths to prevent a systemic collapse.
Right.
Even if it meant nationalize a private company.
It's mind-boggling to think about
The
scale of these bailouts.
Yeah.
First Bear Stearns, then AIG.
Right. Yeah.
But it wasn't over yet, was it?
No.
Wow.
The worst was still to come.
Okay.
The failure of Lehman Brothers and the bailout of AIG triggered a panic in the markets that spread like wildfire.
Wow.
Banks stopped lending to each other.
Okay.
Investors fled to safety.
Right.
And the global economy slammed on the brakes.
So what did the government do
to
try to stop the bleeding?
They realized they needed to take drastic action.
Okay.
Paulson went back to Congress and requested $700 billion for something called the Troubled Asset Relief Program, or TARP.
That's an almost unimaginable amount of money.
It is.
What was the goal of TARP?
The initial idea was to use the money to buy up toxic assets from banks, hoping this would free up their balance sheets and get them lending again. However, as you might expect, things didn't go exactly as planned. TARP ended up being used for a variety of things that weren't part of the original plan.
One of the most dramatic moments in the book is when Paulson realizes that he might need significantly more than $500 billion to stabilize the financial system.
Yeah.
It's almost like he's staring into the abyss.
That moment speaks volumes about the depths and severity of the crisis. The numbers involved were simply staggering.
Yeah.
And nobody had a clear plan for navigating this unprecedented situation.
So the government's bailing out banks, pumping money into the system, trying to restore confidence.
Yeah.
But what about the long-term consequences of the crisis? What are some of the key takeaways?
Well, the 2008 financial crisis had a profound and lasting impact.
Right.
It exposed major flaws in the financial system, the dangers of excessive risk-taking, and just how interconnected the global economy really is.
It also led to significant reforms in the financial industry.
Right.
Although whether those reforms are enough
to
prevent another crisis is a question that's still being debated today.
That's right.
There's a lot of discussion about executive compensation, the concept of moral hazard, and what role the government should play in the markets.
And those debates continue today.
They do.
Should executives be rewarded for taking risks that ultimately lead to taxpayer-funded bailouts?
Yeah.
Does government intervention create a moral hazard by encouraging reckless behavior?
Yeah.
What is the appropriate role for the government in regulating the financial industry?
Yeah.
These are complex questions with no easy answers.
One detail from the book that really stuck with me was the collapse of the Reserve Primary Fund.
Oh, wait.
A money market fund that held Lehman Brothers debt. It caused a panic among investors and really highlighted the fragility of the entire money market system.
The Reserve Primary Fund's collapse was a wake-up call for many investors. Money market funds were seen as safe and stable investments. But this event showed that they were not immune to the risks of the financial system.
Yeah, it's fascinating how the 2008 crisis demonstrated just how interconnected the global financial system is.
It really is.
What happened on Wall Street had ripple effects all over the world.
That interconnectedness is a double-edged sword. It allows for efficient capital flow and investment. But it also means that risks and shocks can spread rapidly across borders.
So, which brings us to what might be the most crucial question of all.
Yeah.
Could something like this happen again?
That's the million-dollar question, isn't it?
Yeah.
There have been significant changes since 2008. Dodd-Frank, for example, was a major piece of legislation aimed at reforming the financial industry. It brought in stricter regulations, increased capital requirements for banks, and created the Consumer Financial Protection Bureau.
But has it been enough?
Well, that's the debate.
Right.
Some argue that it left loopholes that could be exploited,
Yeah.
while others say it went too far.
Okay.
And stifled economic growth.
Right.
The truth probably lies
Yeah.
somewhere in the middle.
And there's also
yeah.
the persistent issue of too big to fail.
Right.
Are some institutions still so large
Yeah.
and interconnected that their failure would pose a systemic risk?
The too big to fail problem
Yeah.
is a real concern.
Right.
Even after the 2008 crisis, we've seen some banks grow even larger through mergers and acquisitions.
So the question is, would the government really be willing to let one of these giants fail if another crisis were to occur?
Well, knowing what we know now about the fallout from Lehman Brothers, would they really risk another meltdown?
It's a tough call.
It is.
On one hand, allowing a major bank to fail could send a powerful message to the market and discourage reckless risk-taking. On the other hand, it could trigger a cascade of failures.
It could.
And send the global economy into another tailspin. It's a gamble either way.
It is.
So where do we go from here? What lessons should we learn from the 2008 crisis?
I think one of the biggest takeaways is the importance of vigilance.
Okay.
We can't afford to be complacent. We need to constantly monitor the financial system for signs of excess risk-taking leverage and interconnectedness.
Okay.
Early detection is key.
What about individual investors? What can they do to protect themselves?
Diversification is crucial.
Okay.
Don't put all your eggs in one basket.
Make
sure you understand the risks associated with your investments and don't blindly chase returns.
Okay.
And never forget that past performance is not a guarantee of future results.
Diving into too big to fail has been a truly eye-opening experience.
It has.
The behind-the-scenes drama. The speed at which things unravel. It's all pretty mind-blowing.
It's a stark reminder that the financial system is complex, interconnected, and ultimately vulnerable to human error and greed. The 2008 crisis was a wake-up call.
It was.
That those lessons are only valuable if we actually apply them going forward.
So, to all our listeners out there, we'll leave you with this. What safeguards are in place now to prevent a similar meltdown? Has Wall Street truly learned its lesson?
Those are important questions to consider.
You are.
After all, the best way to prevent history from repeating itself is to understand how it happened in the first place.
Thank you for joining us.
Of course.
On this deep dive into Too Big to Fail.
Absolutely.
We hope you found it informative and thought-provoking. And maybe even a little bit unsettling.
Yeah.
And over 6'6",